Welcome to Sage at Kapiolani Community College. In this video, we'll take a look at how to handle inventory through the inventory management module. Now, one of the first things to consider is where does your work end up and where does it come from? In the case of costing our inventory and pricing for it, the inventory module acts as the primary place for setting costs and for setting prices. And there is some interplay between that module and purchase order as well as sale order in terms of costing and pricing. There's also reports generated in inventory management, such as a stock status report to tell you where you're at, the reorder report, tell you when it's time to reorder, and the evaluation report, which kind of does a recap of all of your inventory on hand and total valuation. Also, the regular thing that you can always do in every other module, which is go to the management function and a maintenance function rather, and in this case, it would go inventory management, main, inventory maintenance, and then on the transactions tab, you can zoom down there and see what your inventory transactions have shown up like. Now, inventory management is a module that enables all the distribution functions. So it interplays with purchase order, sales order. Sales order generates purchase orders when needed, and purchase order plays into accounts payable, sales order plays into accounts receivable. We don't have it, but return merchandise authorization would also have to work with these guys. Now, most activities in the module that we're using are definitions or setting pricing or costing or adjustments, and sometimes we have occasional error correction that we need to do or things that occur kind of systematically and we normally need to do some kind of repair or maintenance on them. Now there are actual transactions that can be recorded within inventory management, inventory receipts, inventory transfers where we're debiting it to increase inventory adjustments where we're adjusting inventory up. Also, when we have the outgoing direction, inventory issues, inventory transfers where we're crediting our inventory, and inventory adjustments where we're crediting our inventory. Now, in general, there's a date limitation for almost every submodule, and that's to post to the current period and one period in the future, no matter what date you use. Now, General Ledger uses actual posting date to determine the period. Most transactions are going to feed into inventory from other modules. So incoming merchandise is going to come in through purchases, receipt of goods, or through sales returns perhaps. And outgoing transactions are going to come from sales invoicing and purchase returns. Now those occur in other modules and they're posted to inventory typically. Now setup tasks we do, pricing options and sales promotions. Price code maintenance is a thing that manages your pricing strategies and you can use it to apply to broad product types. It uses your cost information and it generates your price or calculates your price based on the costs, including things like quantity breaks and so forth. It's very broad, so things like bikes and accessories could be used in price code maintenance, and you could have less broad ones such as road bikes or mountain bikes, fixies, whatever you want. Now, price level is oriented towards the customer type, and you use that to apply different pricing strategies and to break up your customers into different pricing categories of price levels. So, for example, wholesale, retail, government, etc. Or you might have walk-in customers or basic customers, gold, platinum, and so forth. Now, how they work together can become very complicated depending on what combination you have working, but basically it kind of works like sales promotion maintenance, which is specials or temporary sale pricing is the strongest, so that can override mostly everything else. And then you have a customer pricing schedule that's very strong. And then the other items you have are like the item pricing and their price level, or a price code, or the standard price. Standard price is kind of what you get unless you ask for something else. So warranty codes are a special thing that we use for specifically identified items that have typically serial numbers on them, and that tracks for reporting to the manufacturer or for internal warranty repair or validation and tracking, as well as things like sales opportunity. For example, you just bought a bike. Do you want to have a warranty extension on that because your current warranty only goes for X period of time? Then you would attach it to that serial number. Unit of measure conversion maintenance allows us to break up things like bulk shipments of merchandise into quantities that we typically work with and measure their associated costs. So the inventory system can do the breaking up and dividing up and coming up with the unit costs for us instead of us having to key it in. Now, product lines set up or use internal accounting rules that apply to various lines of products. So the most important thing from this is that the cost that you use and what flows into general ledger will be dictated largely by product lines. And you can apply that to broad classes of product by selecting ranges of item numbers. Kits are a special thing where we use that as a sort of a template for product groupings, like groupings of things that we normally could sell individually, now sold as a bundle. And you can represent typical products like, for example, if you get the seat and the two tires, then you know you have some kind of a kit and you get a little special price break on it. Or you could actually do things like manufacture an entire bike with from various parts that we normally stock individually in inventory. Now, inventory management does work with other modules as mentioned earlier. Your purchase order module comes up with the expected number of units that you're going to buy and the expected unit cost. And when the units are received, the purchase order system generates entry to the inventory management module based on the cost information that it has at that time. We use this account called purchases clearing, which is basically a placeholder account that represents what you think accounts payable is going to be. So let's say we have a receipt. Typical receipt transaction would be to debit inventory account number 120 and credit this account called purchases clearing. So what we've done is we've gotten the inventory into the stock and we haven't really quite credited accounts payable, but we've credited an account that represents accounts payable temporarily. And when we actually get the real vendor invoice with the actual final dollar amount of cost on it, we're going to input that invoice into accounts payable module to pick up the actual cost. And we'll do that by debiting purchases clearing and crediting accounts payable. Now, in theory, this 203 account, purchases clearing, should clean out exactly because the amount of the invoice should be exactly what there was on the purchase order, but it doesn't always work out that way. So sometimes you have to do some adjustments at the end of the month. You should plan on needing to do that at the end of every month. Now, when a sale occurs in the sales order module, the cost for the items of inventory that were sold comes out of inventory. So the sales part is debit to cash or accounts receivable, credit to sales. And the part we're concerned about here with inventory management is a debit to cost of goods sold, expense account basically, and a credit to inventory. You can do adjustments, and when you do adjustments, you have an expense account used called inventory adjustment. And you could also do the reverse of this one that's showing here. So for example, if we had like some kind of a shortage, we could then we could go ahead and debit the inventory adjustment account to be like an expense and credit inventory for this shortage. You could also flip it around, and if there was an overage, you could take it basically out of the inventory adjustment account and put it back into inventory. Now transfers, in general, easy thing to remember about transfers is that when you're moving inventory from one location to another, you just debit the new location and credit the old location. Or you could substitute and say, you know, department or location, either one, and or any kind of combo of those two. So in this case, I'm debiting inventory and crediting inventory, debiting inventory in the new location, wherever that location department, or division rather, and crediting the inventory in the old department, take it out of there. So that about wraps it up. Hope this helps. Thanks.